Welcome to Raveling Money. Today, we will see 7 dangerous investment mistakes that every beginner should avoid. Making investment mistakes can cost you money, as well as make you feel defeated and discouraged. And after you've been defeated by both your mind and loss of your money, you're more likely to make more costly mistakes. However, there are a number of common mistakes to avoid when you are just getting started in the investing game. Yes, it is a game. As life is a game, sometimes you lose, sometimes you win. Most of the time, loss can be a valuable learning experience, but that doesn't mean you should start by losing. With proper awareness and understanding, you can avoid these most common blunders and mistakes, and in doing so, maximize your returns. You should try your best to limit any potential losses. Even the most experienced investors make blunders from time to time. It's all part of the game. Why so many people fail as investors? Most investors will fail because they assume they can beat the markets and properly predict when to purchase and sell. Emotions drive decisions in this situation, and a lack of understanding might result in major financial losses. Investors can fail due to greed and fear, overconfidence, and a lack of actual investing experience. This is especially true if you're just getting started. But don't worry and be put off by this. You will be off to a fantastic start if you avoid or detect some of the most common investing blunders early on. However, even if you understand what you need to do and avoid, you might still make mistakes. Every investor is going to do that. Your goal is to keep the expense of your investment blunders to a minimum. No investor is ideal, and most of us will have our wins and losses in terms of investment return. What's interesting is that many of the mistakes we make are rather common and can be easily avoided to boost the probability of winning more. We would be looking at the 7 most common mistakes and see whether there are any strategies for breaking them, or perhaps using them to your advantage. Mistake number 1. The biggest mistake is an assumption that investing will make you rich quickly. That is being impatient. Putting your money to work can be thrilling, and it feels good. Many people who are just starting wish to get rich quickly. There's always a chance you will make some good money quickly if you do so, but your mindset needs to shift to a long game approach. And sometimes new investors invest without doing proper research and play investing like a gambling game. There is a chance you will make some good money quickly if you do so, but the probability of losing money is high as proper research was absent. It takes time to accumulate wealth, but compound interest and market growth can help your money increase tremendously over time. New investors are frequently taken in by get-rich-quick schemes or mistakenly believe they will become millionaires overnight. The truth, on the other hand, is quite the opposite. Investing is a lifelong habit that demands self-discipline, patience, and a calm temperament. Newcomers who believe they can ride out the market's ups and downs in a gambling investing mindset are setting themselves up for failure. So, instead of viewing investing as a game of chance, do some research before you invest. Mistake number 2. Putting all of your eggs in one basket, which means there is a lack of diversification in the investments. Putting all of your eggs in one basket isn't a good idea. One of the pillars of smart investment is diversification. Diversifying your portfolio lowers your risk by ensuring that if one of your investments underperforms, the rest of your portfolio does not. Professional investors may be able to generate higher return than the benchmark by investing in a few concentrated positions, but amateur investors should avoid doing so. It is preferable to follow the diversity concept. When creating a mutual fund or exchange-traded fund portfolio, it's essential to include exposure to all main sectors. When it comes to putting together a personal stock portfolio, include all main industries as a general rule. Don't put more than 5% to 10% of your portfolio into any single investment. Investors who've had diversified their portfolios with significant gold and debt holdings were less affected by the market meltdown that occurred during the pandemic. Mistake number 3. Falling in love with a brand or company. It's all too easy to fall in love with a company we have invested in, forgetting that we acquire the stock as an investment. Keep in mind that you purchased this investment in order to make a profit. Don't get too attached to your investments. Fall in love with your children, spouse, and other aspects of your life, but not with your stock portfolio. You must remove all emotion from your trading if you want to be a successful investor. So, if you win, enjoy that moment, and if you lose, be sad for that moment. But don't let your emotions influence your decision to sell or buy. Don't become too attached to your investments. Mistake number 4. Investing money you can't afford to risk, ignoring your risk appetite. You'd be surprised at how different your trading approach becomes when you are dealing with money you can't afford to lose. Your emotions are intensified, your stress level rises, and you make purchasing and selling decisions that you would not have made otherwise. Your investment strategy takes a turn for the worst when you invest money that you can't afford to lose. During a downturn, your mind is forced into a corner by projecting terrible loss-bearing future scenarios. Due to heightened emotions and raw nerves, consider your risk tolerance when evaluating stocks, your ability and willingness to lose some or all of your initial investment in exchange for higher returns. Never place yourself in a high-pressure position where you're putting money on the line that you can't afford to lose, like your retirement fund or emergency funds. You will make far more relaxed trading judgments if you invest with money that you can afford to lose. In general, your trades will be far more successful if they are not influenced by negative emotions or fear. Mistake number 5. Investing in a business you don't understand. Never put money into a stock. Rather, put your money into a business. Also, invest in a company that you are familiar with. To put it another way, you should know what business a company is in before investing in it. Commonly, the hot tip or skyrocketing growth of a penny stock has nothing to do with the company's fundamentals, and more to do with widespread dishonest guessing among market players. People were buying a stock of businesses with little earnings and no business plan just because the price was increasing. It was bad loans a few years later. The poorest mortgages were cut and diced before being packaged as apparently A-rated bonds. When something seems too good to be true and you're not sure how it's possible, trust your instincts and flee as quickly as possible. Make sure you're not one of them by investing in companies whose complexities you do not fully understand. Second, always rely on well-researched stock market calls and data from reputable stock market specialists. Warren Buffett, one of the world's most successful investors, advises against investing in businesses whose business strategies you don't understand. Building a diverse portfolio of exchange-traded funds or mutual funds is the best method to avoid this. If you decide to invest in specific stocks, be sure you know everything there is to know about the companies they represent. Mistake number 6. Trying to time the market. Market timing is a common phenomenon among stock market investors in which they make purchasing and selling decisions based on their forecasts of future market price fluctuations. A lot of mutual fund investors try to time the market as well. When they believe the market is about to crash, they try to sell their investments. These forecasts may not always come true. Many professionals and researchers believe it is impossible to time the market. Furthermore, attempting to time the market will result in your goals not being met. The reason for this is that by redeeming your investment anytime you believe the market is about to crash, you are missing out on chances like compounding, which allows you to attain your objective faster. Mistake number 7. Stop investing when the markets are down. Global markets took a hit when the pandemic broke out. As a result, many investors had decided to terminate their SIP and investment plans. That is a very risky practice. What investors forget is that the losses incurred as a result of a market crisis are merely paper losses. Only when you withdraw your investment, it becomes a true loss. That is something you should never do. The nature of markets is cyclical. It's not as if a terrible cycle will last forever. Markets will eventually correct themselves, and your investment value will rise again. Market corrections have occurred. If you see present situation, the market is now on an upward trend. So don't stop investing. So, to summarize, one of the most common investment mistake is not investing at all, as you will miss out on the magic of compounding interest. When it comes to investing, It's crucial to be aware of some frequent mistakes so you can avoid them. It's also crucial to diversify your portfolio and avoid investing in stocks you don't understand. Expecting too much, risking more than you can afford, and failing to complete appropriate research before investing are all classic blunders. So that's it for this video. Subscribe to our channel for more informative videos like this, and have a great day.